Hello, everybody, and counting 110 ACC 30240. We're going to go over chapter 3 here. This will be the chapter 3 lecture. And it's a real important one in that we're now introducing the accounting language of debits and credits. And you're going to struggle a little bit till you get the debits and credits under your belt. There's really just 5 things to know here. So let me go into the PowerPoint. And what I'm going to do is take us through the same transactions we did in chapter 2, only this time we're no longer saying plus, minus, add, subtract. We're going to use the word debit, credit when appropriate. So here we go. I need to share the screen, I believe. So hold on, please. Let me go back over here and share the screen. Share and share alike, right? Here we go. I trust you can see that. And I'm not going to enlarge it because when I tried doing this earlier today, we had a problem. I actually did this lecture for a few students who came in live, and the video just didn't work for whatever reason. I did push the button to record it, but we didn't get much. So here we go. The double entry framework. We should know by now that every transaction requires a debit and a credit. Okay. 2 accounts are affected with every financial transaction, and those debits and credits have to equal. And as long as the debits and credits equal, our accounting equation is in balance, and our accounting equation can never go out of balance. So we're going to look at a T account. A T account is really a piece of scrap paper. It's used to organize data and make it easier to follow. You could be working in accounting for 40 years and be at a meeting, and next thing you know, you're up at the blackboard or the whiteboard, I guess, saying, let's put it into T accounts and see if we can figure out what happened here. A T account mimics the general ledger. A T account is the poor man's general ledger. The general ledger being the place where your financial data resides, the books of the company. It's where transactions end up being recorded. So a T account is simply a T-shaped item, huh? And it has a debit side and a credit side. Debit and credit mean just one thing and one thing only, and that is left and right, okay? Left and right. That's all it means, left and right. Debit left, credit right. It doesn't mean up, down. It does not mean plus, minus, increase, decrease. It's not a good thing or a bad thing. It is absolutely neutral in all ways. Some accounts have what is called a debit balance, and others have what's called a credit balance. And that's what we're going to review here. The T account has an increase side and a decrease side. Notice that it didn't say the debit side was an increase or or debit side was a decrease. Each side has an increase or decrease side. An asset has a normal debit balance, meaning that when you debit an asset, you are increasing the number. If it was accounts payable, which has a credit balance, the credit side would increase it. We are going to go into this in a moment. Some accounts increase on the debit side and some on the credit side. Regardless of the convention, the debit side is always on the left, the credit side is always on the right, and sometimes you're increasing and sometimes you're decreasing. Let's look at a T account. This is your general ledger, huh? This is a T account, and it also mimics the general ledger. Here is your cash T account. You will have one T account for everything in your chart of accounts, starting with cash. You'll have one for cash, accounts receivable, inventory. Then you go into your liabilities, accounts payable, notes payable, equity. and then revenues and expenses. You will have one of these T accounts or folders, if you will, for every item of interest that you want to track. So let's take a look at our cash account here. Let's see what these numbers look like. Cash. I see a $2,000 debit. That could be the first transaction in the cash in the company's history. This person put $2,000 into his business and he debited cash, which increased it, and credited equity with a credit. Then he spent some of this money. Here he went out and bought some equipment, maybe. He maybe bought some more equipment. We don't know from looking at this. But the point is, the debit side represents increases of cash, cash receipts, if you will, and the credit side represents cash disbursements. You add the two columns down, and the high man wins, meaning 3,500 total debits less the 3,130 in credits is going to leave you with a balance of $370. That is the normal balance of an asset. A normal balance means the side of the T account, debit or credit, which increases it. Assets have a debit balance. Our accounting equation is assets equal liabilities plus equity. So if you know that assets have a debit balance, by definition, accounts payable or liabilities and capital have to have a credit balance. And let's continue here. Describe the effects on specific types of accounts. Well, here we go. To debit an account means to enter an amount on the left side. Remember, debit means left, credit means right. There is no other meaning to those two words accounting-wise. To credit an account means you entered it on the right side. A debit may increase or decrease depending on the account. A credit may increase or decrease depending on the account. And you just have to understand, and hopefully when you get through this chapter, you make an earnest effort at the homework and study up a little bit. The debits and credits should sink in. Assets, like we said, have a debit balance. They go up on the left side and down on the right or credit side. Assets, like we just said, assets, if assets have a debit balance, then the other two components of the accounting equation, capital and liabilities, would have to be the opposite. Liabilities, accounts payable, notes payable, mortgage payable, whatever. This account goes up with a credit. Owner's capital, up with a credit. And I can give you a couple of mnemonics to help you, try to memorize them. But the best way to understand them is do the exercises and look at these different helpers we have in here, okay? You have to get to the point where you know an account's normal balance without even thinking about it. You need to know debits and credits, like I can tell you who won every World Series game ever played. It's that kind of thing you need to put together, okay? Revenues. Now we're introducing the other two items, really. Revenues have a credit balance. Revenues go up with a credit. You sold something to somebody for cash. Well, obviously your cash went up, so you will debit cash, and revenues have a credit balance. Again, if revenues have a credit balance, expenses would have to have a debit normal balance. Revenues credit balance, expenses debit. Here's an account we're going to talk about, drawing. I think we know what this is already. This is the boss taking money out of the business for personal use. Obviously, this would be a small operation. Bill Gates doesn't walk in and ask his secretary to hand him $100 and then he write a drawing entry against Microsoft. No, this is for smaller business, but we need to understand this. Drawing. You're in the accounting department and the boss comes out and says, I want $2,000, please write me a check. And of course you say, yes, boss, what's it for, please? and the boss will say, I'm taking my husband and children to Disneyland for a week. Well, as soon as you hear that, you know it's a personal item. It has nothing to do with the business. So we are going to credit cash, because that's what the boss took, and we're going to debit this account called drawing. And this account called drawing will reduce capital. It's a part of your capital. It's what's called a contra account, meaning in this case, a contra capital account carrying a debit balance. And the reason we have this separate account from capital is we certainly don't want to mix up anything that the boss does personally into the capital number. So we isolate these personal drawings into this account called drawing. So those are really the 6 things we need to have under our heads here. This is a nice presentation, and I'm trusting you can read this. The accounting equation and the owner's equity umbrella, huh? Assets have a debit balance and they equal liabilities, credit, and equity, credit balance, huh? Assets debit, therefore liabilities and equity would have to be the opposite, credits. And then you have your revenues, which have a credit balance, and your expenses, which have a debit balance, and then the outlier, the contra equity account called drawing or withdrawals, which has a debit balance. Notice the umbrella. The umbrella says owner's equity, and under that umbrella are your revenues, your expenses, and your drawings. They're under this umbrella because every time you sell something, equity increases. Every time you incur an expense, equity would decrease. And if the owner takes money out, that would also decrease your equity. The value of the business is no longer $10,000, it's now $8,000 because the boss took 2. So this is a nice thing to be looking at. Perhaps have this in front of you, print it out if you can, or have it on a screen somewhere while you're doing your homework, mastering the debits and the credits. This is an even more useful grid here. Assets, liabilities, capital, revenues, expenses, drawing. These are the 6 things we have to memorize. We have to know immediately assets have a normal debit balance. I don't even think you need to look at the increase or decrease side. I would suggest concentrating just on this last column, normal balance. Assets have a normal balance. Normal balance of an asset is a debit. That means that the debit side increases the dollar amount. The normal balance is the side of the T account which increases the balance, okay? So assets have a normal debit balance. Well, if a debit increases cash, we can intuit that cash goes down with a credit. That's why you say you get 2 for 1 here. You understand this 4th column, you automatically understand this. Again, assets equal liabilities plus capital. Capital and liabilities have a credit balance. An increase in liabilities requires a credit. Same thing with owner's equity or capital. And then we come to revenues, credit. Once we know revenues are a credit balanced item, a normal balance of a credit, we should figure out that expenses then would have a debit balance. And then again, the outlier is the drawing, the contra. The drawing is a part of the capital, but it's isolated because we don't want to present the owner's business anywhere in our capital number. So these are the 6 things. When I say you have to memorize debits and credits, these are the 6 things. Assets, liabilities, owner's capital, revenues, expenses, drawing. Let's go on and see what other goodies they may have for us here. This thing is giving me a hard time. Let's come on, get out of here. Okay, let's do some transactions now. What we're going to do is we're going to record the same transactions we did in chapter 2, and you all did very well with that, from what I can see from the homework, and just in talking to so many of you. So let's see what we have here. We're going to use the T accounts to analyze. And you're going to go through the same process. What happened? What accounts do we charge? So let's go right into our first transaction. Mitchell Williams, the owner, invested $5,000 in the business. Well, what accounts do you think are going to be affected? Well, he put cash into the business, and the business is now worth $5,000. And that net worth of the business is called capital, in this case specifically, Mitch Williams Capital. Cash is an asset. Capital is equity. Debit cash, because assets go up with a debit and capital goes up with a credit. So let's take a look at our accounting equation after this. Assets equal liabilities plus equity. There's your balance right there, your general ledger right there. Let's go to the next one. And here's the balance here of capital. So what do we got here? Oh, this thing is starting to get on my nerves. Okay, we purchased an asset for cash. We bought a motor scooter. Well, a motor scooter is an asset. Obviously, it's something of value we own that's going to help us make money by delivering pizzas all over SBCC and UCSB and Westmont. Huh? I'm assuming this guy delivers pizzas. So we bought a motor scooter for cash. So we're going to call that motor scooter delivery equipment. We could have called it motor scooters if we wish to call it that in our chart of accounts, but we chose delivery equipment. They're both assets. One asset goes up and one goes down. The asset that goes up is the one we debit. We debit delivery equipment and we credit cash. It really had no impact at all on this accounting equation. It was 5,000 equals 5,000 before. It's just that it's no longer 5,000 in cash. We now have two assets. Let's see what we have after this. Wow, now we purchased an asset on account. And you always hear me say this, on account. When you see those two words, it means on account and nobody had money. It means that there is no cash in this particular part of a transaction. On account is going to end up with a charge to either accounts receivable, a debit, or a credit to accounts payable. And it's easy to get confused between the two, and that's why you just have to read the problem a little bit. So as soon as you see we're purchasing something on account, it means we're going to have to pay for this later. So we bought another motor scooter, delivery equipment. The asset goes up with a debit, and this liability goes up with a credit. So here we go. We now have a third piece of our accounting equation. The assets now total 6,800. He started with 5,000 in cash, it's down to 3, plus this stuff. 6,800 equals 5,000 plus the 1,800. We are in balance. You can never go out of balance, not even for 1 second, okay? Well, look at this. We owed, how much we spend here? We owed 1,800. Then maybe a couple weeks later, we paid 1/3 of that. 1/3. Okay. Well, what happened here? We reduced our debt, right? We don't owe 1,800 anymore. We only owe 1,200. So we get to reduce accounts payable with a debit and credit cash with a credit. This payment decreases the asset, decreases the liability. So there's an example of a journal. I say journal entry. I will say that the example of an entry that affects two accounts in the same direction, one with a debit, one with a credit. And again, after each transaction, we're going to go to our accounting equation and see that we're in balance now. Okay. Nothing changed except the cash here. This was our cash expenditure, $600 credit. That reduced cash accounts payable, which has a credit balance. The debit reduced it. Hey, we delivered some pizzas. We delivered $2,100 worth of pizzas to all the dormitories and all the students around town here. And we received $2,100 in cash. This is our first transaction now that brings in a revenue. And a revenue is also a sale. Revenue and sales are interchangeable. And we're not calling it sales, we're calling it delivery fees because we're a specific delivery guy, right? So we received cash, increased the cash, and increased the revenues. And one is debited cash, and the delivery fees are credited because, as you know now for sure, revenues have a credit balance. And now here comes the umbrella. Remember they had an umbrella up on this side? Under the owner's equity, we still have equity of 5,000, but right now we have revenues in the form of delivery fees for 2,100. And our accounting equation is still in balance. The 8,300 equals the 7,100 plus the 1,200. We will go to another transaction. We paid rent. As soon as you see paid, you know it's a credit to cash. Clear language, right? Paid means cash went down. We will credit cash for 1,000, and we will debit, in this case, rent expense. Decrease the asset, increase rent expense with the debit. Debit rent expense, credit cash. And here we go. So the cash now has gone down again by $1,000 to rent. And now we have our first expense. If the month ended right now, this company has sales of 2,100 minus 1,000. That's a profit of $1,100 right now. That's how you could look at that at this point. But there's more to come. Paid $100 phone bill. This company calls the phone bill, calls the telephone phone expense. It could be called telephone expense. If you're not interested in tracking your telephone expense, maybe you can just throw it into utilities expense. But most companies, of course, have a telephone expense account, okay? And again, we are increasing the increasing the expense, phone expense, and reducing the cash. And our umbrella just has a new item in there, huh? Cash down 100, expense up 100. I think you can see this is not too terribly tough as long as you remember the rules about debits and credits. And as easy as I tell you it is, I know it's a struggle to get this under your belt. Anybody in our class who took 110 can tell you that. They have a nice head start on the people who jumped into 230 without 110. But after chapter 5, all bets are off. It's all loose. Oh, this is 110. We're taking 110. I was talking to the 230 class a couple times online. Forgive me. We're all in the same boat. 110 it is. Delivery revenues earned on account. Mitch made deliveries on account. And again, on account of there's no money. There's no money. Nobody had money. But the deal is we deliver $2,400 worth of pizzas, and we will hand that person a bill, and then we get paid in 30 days probably. We charge the students $2,100 cash because we don't trust the students. We can't give any students credit. But this is a big party for the faculty and the muckety mucks at the different schools, and we are willing to give them some credit. So here, two things are going to go up. Accounts receivable, which is simply the dollar amount that all of your customers owe you at that point in time, and delivery fees. They go up as well with a credit. So we've introduced a new asset here. We now have an asset called accounts receivable. These schools owe us $2,400. and we record that as revenue. Notice the revenue is recorded at the time we delivered the pizzas. It has nothing to do with when we get paid. Sometimes the revenue and the cash coincide, but for the most part, that's not going to be the case. But you have to understand that we are going to record all revenues and all expenses on an accrual basis, meaning when they occur, when we incur them, when they take place. So as soon as we drop these pizzas off on January 31st, that is a January 31st sale. And the fact that we get paid in February does not cut any ice, as we say. We're back in New Jersey where I'm from. Don't cut no ice, you know? Oh, for heaven's sake, give me a hard time. We purchase supplies, and as we know in our 110 class, supplies, when you see the word supplies, it's an asset. Doesn't have the word prepaid in front of it, which irks me, but that's okay. When we see the word supplies in this class, it's an asset. When it's an expense, it will say supplies expense. So Mitch went out and he bought $80 worth of papers and envelopes and things. And he did so with cash. So the expense is going to go up, debit, and the cash is going to go down, credit. Okay? I think we're pretty clear on that. So here you go. Here's the cash coming down, and we've just added another expense. Oh, see how stupid I can be. It's not an expense because we're using the supplies later. It's an asset. I don't think there are too many companies in the world, class, that spend only $80 and then they put it on the balance sheet until they use it. Normally, it's a much bigger number. But yeah, the asset supplies went up, and so the cash went down. Okay, supplies. We're not going to record supplies expense until we use the supplies. Say hello to chapter 5. Next transaction, cash receipts from prior sales on account. Remember, we sold $2,400 worth of pizzas, and we agreed to wait and get paid in 30 days. Well, look what happened. They paid $1,900 maybe in a few days, right? So now we have cash. So the cash went up, and we already recorded the revenue. The revenue has nothing to do with when the cash changed hands. The revenue has nothing to do with when the cash changed hands. So we are going to record our journal entry. We are going to debit cash and credit accounts receivable. Before we got this money, these people owed us $2,400. Now they paid down $1,900 of it. So let's look at our accounts receivable. 24 minus 19 is 500. This is the balance here. These people now owe us 500. Okay. So that went down with the 1900 and the cash went up. We exchanged one asset for another. Accounts receivable is a great asset to have, assuming you have good customers who pay you, but cash is even better, huh? Now, here we go. Now we've got a 3-line entry. As you know, minimum is 2. You must have 1 debit and 1 credit. So let's take a peek at this one, K. Purchased an asset on credit, making a partial payment. So we bought a motor scooter for $1,000. He's buying motor scooters like crazy, huh? So now we have an asset that came into our business worth $1,000. So we know we're going to debit that for $1,000. And we made a down payment of $300. Well, that means we wrote a check for $300. But now we agreed, the supplier, rather, the sales guy who sold it to us, he agrees we can pay the guy in the future. That is the difference of $700. That's the liability. We're going to debit delivery equipment for $1,000. We're going to reduce cash with the credit, and we're going to increase accounts payable, which has that credit balance. And here we go. I said, here we go. We're back to our famous umbrella here. So let's look at the accounts payable. We had $700 layered onto that because that's how much we owe. We had to make a down payment of $300 in order to bring in another $1,000 motor scooter. Okay. Come on. Payment of an insurance premium. Here's your classic prepaid asset. We bought an insurance policy, I'm going to assume on December 31st for $700. That policy was purchased December 31st, 2019. It provides insurance, though, in the future for the next year, 2020. So when we bought this insurance policy, we have not gotten any benefit out of it yet. It's an asset. We're not going to get any benefit until January 1st. If the business burned down, God forbid, on New Year's Eve, we have no insurance. If it burned down after midnight, we got insurance. You get the idea. So that asset is called a prepaid insurance, and we increased that asset by $700. So we threw another asset up here. Here is another asset we just added, prepaid insurance. Cash goes down. Again, an exchange of one asset for another. Payment of wages. Wow, we got people, someone's riding these motor scooters, delivering all these pizzas, and we have to pay them, huh? So Mitch has recorded this expense with cash. He paid these people, and his chart of accounts calls the wages expense. It could be called wages and salaries expense. It could be very detailed. You could have wages dash California dash. You get the idea. It can be as detailed as you want. Here, wages expense is good. So wages expense went up with this 1,650, and the cash went down by the same amount. Debit, credit, wages expense is now popped up under our umbrella, and the cash went down. Okay. You know the old expression, class, let a smile be your umbrella. You never heard that? Let a smile be your umbrella and you'll get a mouthful of rain, I believe. But anyway, we'll go from here. No more bad jokes. I try to promise. Delivery. Now we delivered some more pizzas. We went back to all these schools and we had a nice month, huh? In the last, say, week of the month, we delivered $3,500 worth of pizza. That's revenue. That's revenue. Because we don't care when we get paid, we care when we delivered the pizza. We are going to credit delivery fees, $3,500. That will be an increase in the delivery fees. The students paid us $900. We collected the cash every time we dropped off a pizza. And the $2,600, the balance, that was for another faculty party where we trust the people to pay us. That will increase your accounts receivable. So you can say to yourself, we had $3,500 worth of revenue, and our customer financed it by paying us $900 down and pay later. So our accounts receivable took a big jump. Okay, cash went up because we collected that $900, and now our revenues. We had these three revenues here, and we subtract all these expenses. That's our profit at that point in time, huh? Here is our famous withdrawal. Withdrawal. Mitch came out and said, I need $3,000, and I'm using it because I'm going to the Kentucky Derby, and I'm going to bet the entire $3,000 on Tiz the Law, the big favorite in the race Saturday. Super Horse, supposed to win that race. He withdrew $3,000 from the business. So obviously we have less cash, and that goes down with a credit. And I'm going to use the word obviously one last time on this, because we know the business is no longer worth $3,000. we've lost that amount of money, that amount of net worth, but we're not going to debit capital. We're going to debit drawing, Mitchell Williams drawing, and the drawing and the capital number will be netted together eventually. So here we go. We gave him $3,000 to bet on Tiz the Law Saturday, and we debit withdrawals. A capital account with a debit balance. It is a contra account. Contra. Okay. Now we've done all this work all month. You worked hard, everybody. You were preparing these different entries and you were analyzing things and you recorded all of the transactions. To what end? Now, the idea is at the end of the month, we want to see if we made money, if our business is successful. So the first thing we're going to do at month end is we're going to prepare what's called a trial balance. A trial balance is simply proof that the debits equal the credits. That's all it is. So the trial balance is prepared at month end, or you can do it anytime you want. But typically month end, you run your trial balance. It lists all of the accounts in your world, starting with cash all the way down to your last expense. And you're just got two simple columns. You're going to have a debit and credit column. And if the trial balance shows that the debits equal the credits, that's good. That's all it really can tell us. Does it mean that the trial balance is correct? No, everything can be wrong. And you're going to learn in chapter 4 and 5, I believe, that by definition, when the trial balance is first prepared, there will be more to do in terms of transactions. And we'll get to that after this chapter. Trial balance is not a formal statement. It's a worksheet, and it's a very good aid in preparing financial statements. Where I worked for all these years, we would run the trial balance as soon as the first day of the month began, and then we would go over it and we would look and see if things were right, and we keep making corrections as needed, and then run another trial balance. And you'd hear people running around the office, who's got the latest trial balance? I need to look at it. Trial balance. Listed in assets, liabilities, equity, revenue, expense order, just like your chart of accounts, okay? In a specific order. And your assets and liabilities are further sub-sorted, if I can say it that way, in terms of liquidity. Cash is very liquid. Accounts receivable is liquid. Liquidity means the ability to turn an asset into cash. Well, there's nothing more liquid than cash. Accounts receivable, very liquid, because you know you're going to get paid. If you had $1 million in accounts receivable now, you could go to a bank in town here and say, look, I got $1 million. I know these are good customers. They're going to pay it. How much will you give it for me today? I can't wait 30 days. And the bank will say, I'll give you not $1 million, I'll give you 700,000. And you might take it if you needed the cash desperately. Same thing with liabilities. You listen to equity, liquidity. Here we go. Let's look at our trial balance. Let's see, cash, they got a debit of 470, accounts receivable. Where did they get these numbers? Where did they get these numbers? Where? I'll show you where, and you should know where. They came right out of here. This is our general ledger. Came right out of these T accounts. This was our last transaction. Look at the balances. Cash has a final balance of 470. I see 3,100 for accounts receivable. I see our revenues are that, I guess that's, I can't read that, 8,000. The point is, these numbers represent the month-end balance of each T account. And if debits equal credits, we're okay. And I'm going to go off on a slight tangent. You are probably never going to have to worry about the trial balance going out of balance, because no accounting software, I don't care what it is going to let you put in an entry that knocks it out of balance. Unlike when I was doing this in the Stone Age, where you actually had to do this in pencil and paper. and you'd run the trial balance, and it would be out of balance. And boy, that was a problem, because it stopped you dead in your tracks. You got to go back. Let me have a quick snort here. Oh, that's good booze. Okay, let's go to the trial balance. Debits equal credits. This is not going to tell anybody anything. This is not a financial statement. No one's going to want to see the trial balance. No investor in the world has said, wait a minute, I see your income statement and other things, but I want to see your trial balance. No, it's just it's just a worksheet, is all it is. Now, here we come to the guts of this chapter, these last few slides here, and I'll let you go and do your homework. The trial balance is here. What they're doing with the colors is they're showing you that these are assets, liabilities. Let me give you the Bob Smagula tip there, okay? Go to your first revenue line. Remember, this is in order by assets, liabilities. We have two capital accounts, and then revenues and expenses. Draw a horizontal line across here above the delivery fees. The reason for that is everything below that line is your income statement. It's that easy. Everything above it is your balance sheet. So what they're showing you here, the delivery fees were $8,000 minus these three expenses would give you your income statement, and everything above delivery fees would give you your balance sheet, with one exception. We have to update the capital with the drawing, get rid of the drawing, and then put this profit, whatever it might be, into capital. So let me show you here. This is a well done sheet, I think, here. Okay, we went to our trial balance, and we know everything below the drawing is our income. 8,000 minus looks like three expenses. Huh? 8,000. What were the three expenses? Wages, rent, phone. He had a nice profit. It looks like a $52.50. That's pretty darn good, huh? He invested $5,000 to deliver pizzas, and he added another $52.5 on top of that. This guy made some big money, huh? So that income is going to come over to your next statement, the statement of equity, and then we'll go from there to the balance sheet. I'm going to go back to the income statement. The income statement is your revenues minus your expenses to get your net income or net profit. That's an acceptable word too. Profit, income mean the same thing. And your statements will all start with the name of the company. It'll have whatever the statement is. And then you're going to either say for month ended on here and here, or here you're going to have a hard date. And we'll get to that in just a moment. And this thing can be set up in various presentations. I think this is a good one. On the far right, you put the total revenues. On the far right, you put the total expenses, and the difference is your profit. And then one column over, you list all of your expenses, okay? We take that profit, and now we're going to use it to do the statement of equity. And students get nervous at the statement of equity. They say, man, I understand the income statement and the balance sheet. This one gives me a hard time. Let's talk about it. It really shouldn't. This statement here is really your beginning equity statement plus your net income minus drawings gives you your ending equity. That's all we're talking about. Beginning, income, drawing, ending. Bide your time. BIDE is what I use for the equity statement. So let's see what we have here. We start out with 0, but let's call the 5,000 the beginning. That's the real beginning of the business, right? So our beginning equity was 5,000. Our income was $52.50. Income, of course, increases your equity. The 3,000 this guy drew out reduces your equity. So our profit was 5250, but the capital only increased by 2250. So now his business is worth $7,250 at the end of the month. Okay? That $7,250 will automatically become your new balance on the balance sheet. You notice you do not see drawing on the balance sheet. You will never ever see drawing on a company's financial statements, because those represent the personal drawing, the personal use of company cash for the owner's own benefit. And I don't think you ever want to show it there. If you showed it there separate, the balance sheet would be correct, but I don't think you want the world to know that you took 60% of your sales and used it for to bet on a horse race. So this ending balance comes right down to here. So my question now is, where did we get the rest of these balances? And I think you know where I'm going with that. We got them from, come on, we got them from the trial balance. We picked them right up from here. We picked them up from the ending balance. So on the balance sheet, you just copy everything from the trial balance, with the one exception. One exception is the capital has to change to reflect the net income. And I guess I'm sad to say we're at the end of our slides here, but let me talk just a moment here. Most of you are keeping up with the chapter summaries nicely, and the exercises and the quizzes. Keep doing that, obviously. I appreciate the work you're putting in there. Some of you are falling behind or are turning things in late. If you're turning things in late, you don't get the full credit. So obviously it's in your best interest to get it done on time. Those of you who have not done some of the assignments and they're well past due, you have until the end of the semester, the way I set things up, to get them done. Of course, you're not going to get the full credit for it. So we always welcome you to catch up, okay? I believe we have a test on Monday or Wednesday. From the session we had earlier, I was led to believe it was Wednesday. If that's the case, we'll have a chance to have a real good test review on Monday. I'll find out today for sure. There's a little bit of a confusion, at least in my mind, when the test is supposed to be. The test will be on the first 3 chapters. And right here, this is going to be probably a big part of the test, right? Chapter 3. We get through chapters 3, 4, and 5. You should be fluent in the language of accounting, meaning mastery of the debits and credits, understanding what an asset is, what these financial statements tell us, and then we'll get into some more real world type situations. We'll get into a chapter on selling things on credit to customers, and what we do when customers pay us, what we do when they don't pay us, and different things. So I think that the course gets maybe slightly more interesting at that point when we get into some more realistic type things. This is the grunt work right here, the first 5 chapters. So after this, we should be in pretty good shape. And I'll let you all go, and I hope you had a great holiday. You know how to get a hold of me. For the quickest response, usually would be to text me. You have the number, and I can normally get back to you pretty quickly with a text. Not always, it depends. Next best is my personal email account. Next best would be the pipeline, okay? But I will get back to you as quickly as I can. Okay, so keep up the good work, everybody, and we'll hook up maybe later this week, and definitely a week from today, okay? Bye-bye, everybody. You've been a great audience.